Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema. With me is Surbhi. For the benchmark indices, we're holding up pretty okay, right? The Nifty and the Sensex continued with their upward momentum. The Nifty is up 85 points, closer to 22,650. The mid-caps and small caps, after last week's one-way up move, have paused a bit. The mid-cap index is flat. The Nifty small-cap index is down in the red, down nearly about 0.5%. And that's the reason why the advanced decline ratio is in favor of more stocks declining versus advancing. 2:3 is how the ratio looks right now. And banks are not participating today.
Yeah, absolutely. I think, banks is the only niggling issue with the market. Otherwise, it's not a bad screen at all. Because while at a headline level, the mid-cap index is not in a runaway mood, individual names, I mean, there's enough buying going on in specific names today. But the Bank Nifty, yes, that is a bit of a problem point. And of course, the starting point of that problem has been IndusInd Bank today because of the fact that Mr. Katpalia's extension is only for 1 year and not 3 years, which is what the bank board had asked for. So that's still weighing. Look at that IndusInd Bank. It's still not been able to recover meaningfully from the opening gap down. So that definitely is a pressure point. Since we're talking about the losers, let me tell you what else is not working on the Nifty. There's L&T, which is another large cap name that's putting downside pressure. There's HDFC Bank, which is also taking things on the lower side. Trent is seeing additional selling. Trent has seen such tremendous value damage from the peak. Let's pull up Trent. This year, January, February, and so far in March, Trent is down 31% already. It's already seen a 41% destruction from the top, from the peak. That's this year, and the high was above 8,000 rupees for the stock, and now it's a sub 5,000 rupees stock. Today, Kotak has come out with a note saying that, they're expecting some weakness to persist. Anyway, Trent is one stock that's down. But now let's talk about the good side of things. Plenty of buying in a couple of PSU names that are still looking quite robust. PowerGrid is actually topping the charts, 3.5% up on PowerGrid. There is HUL, JSW Steel, there is Hindalco, there's Infy, and there's Britannia Asian Paints. So you can see the leaders list is very mixed. It's got all kinds of names. There is some consumer buying and there's some PSU buying. But what's also interesting is that Infosys is managing some green on the screen. So let me toss it back to Reema to find out what's making Infosys a little happy today.
Well, CLSA has upgraded Infosys to outperform from a whole rating, and their target price is 1978, so about a 13-14% upside from current levels. Here are the reasons. One, valuations currently are at a 7-year average level, so pretty much in long-term averages at close to about 24 times. Secondly, Q4 is expected to be a weak quarter because the wage hikes come into effect, so therefore margins will get compressed, but that is priced in. But over the medium term and long term, CLSA believes there are positive tailwinds. So discretionary spending is reviving in two key verticals, banking and retail. And yes, while you hear a lot of noise about what if the US growth slows down, etc., to which CLSA says that the commentary from the US banks so far is upbeat. None of them are talking about bringing down their tech spends, which means at least for this calendar year, the BFSI recovery should continue, and retail too is seeing some positive momentum. The other worry in the market's mind is what if European automotive companies, EU auto companies slow down on account of tariffs? Now here CLSA believes that Infosys could be a beneficiary because these companies, in order to save costs, by these companies I mean the automakers from Europe, will go for vendor consolidation, cost takeout deals, which could be positive for Infosys. So they could win mega consolidation deals on that front. So therefore, over the medium to long term, there is a discretionary tailwind, and according to CLSA, Infosys is best placed for that. The only thing is, because of this tariff uncertainty, they're saying next year's guidance, which the company will give only in April, that could be a little wider. So typically the company gives about a 2 basis points, guidance difference, right? It'll be a 6 to 8, 4 to 6, 2 to 4. But this time it could be a wider because of just the uncertainty surrounding it. So 4 to 7% is what they're expecting on Infy. But bottom line is medium to long-term, discretionary benefits, demand tailwinds. Stock is not pricing it. Valuations are fine right now, hence the upgrade. The other one we're watching is Wipro, because Macquarie hosted Wipro's management for a non-deal roadshow. And again here, they had to field questions surrounding that is demand slowing down because of what's happening on the geopolitical front. Now here, Wipro has answered saying the discretionary demand uptake has continued. We can see that in our consulting business, Capco. Secondly, in BFSI also it continues, but it's not broad-based. There are certain pockets of worry. In some place, things are holding up. The company for now is maintaining its Q4 guidance on the top line. That's -1 to +1. On margins, it will be maintained. They will operate in a narrow band, something that they've spoken about in the past too. So Macquarie is bullish on Wipro, outperform rating, and they expect the company to narrow the growth gap versus peers. So stock is down. But the commentary
the brokerage commentary is
from their management is stable.
Okay. All right, got it. So that's Infosys and Wipro. Let's look at one midcap that's been making headlines for all kinds of reasons over the past couple of trading sessions. I'm talking about Gensol Engineering. Now, we all know there were lots of issues about perhaps defaults or some allegations of potential, fraud as well of some nature. And then we got the management on the show last week. Now, promoters have sold some equity in the market. What they're saying is that money will be reinvested back in the business. Let's understand what's going on. We have Hormaz joining in. Hormaz, this is like the latest Bollywood pot boiler, right? Always a twist. So what's the latest one?
Oh, absolutely. And Abbas Mastan would surely be eyeing this one. But yes, the management did say to us when we grilled them last week that they will be buying shares from the market instead of although they did not share a timeline as to when they would do so, but instead on Friday, they ended up selling shares in the market. And while a lot of these reports attributed to a margin call, it may not be necessarily that, because they are going to be reinvesting the proceeds back into the company. At least that's what the press release says. And now the proceeds will also be infused in the warrant subscription round that was done at a much higher price that was executed in the month of June of last year. And despite the stake sale, the promoters still hold close to 60% stake in the company. Mind you, most of that is pledged. Now, the other announcement that they made on Friday is the fact that they are going to hold a board meeting this week to consider fundraising proposals that will be done via QIP or other methods. And more interestingly, they'll consider a stock split on the 13th, and this after the stock has corrected almost 75% from the peak, which was around 1100 rupees. The stock is currently languishing at 300, and they're going to do a stock split after this. Now, they have earlier issued bonuses as well. They've issued a 2:1 bonus in October of 23 and a 1:3 bonus in October of 21. Now, and as we mentioned, the promoters spoke to us. They also mentioned that they remain fully committed to the business. There are no wrongdoings that have happened. They have formed a private committee as well to be investigated. But right now, all of these developments raise more questions than answers.
Thank you very much for that. And uncertainty prevails in the stock price too, down nearly about 3.5%. Turn our attention to the commodity market, because that's where it's all happening. Brent had moved up above that $70 per barrel mark, but once again below that level. Manisha is back with us to talk more about crude and the latest sound bites.
Well, thank you for that, Reema. Well, yes, continues to be very, very choppy as the statements continue to come in US on whether there are tariffs or no tariffs, or they have been eased or brought down or liquidated. That exactly is what is impacting the crude prices also. The markets are getting worried about on whether, one, there are tariffs, two, if there are, then that could hurt the economic growth and the energy demand as well going forward. It also is going to be about the US crude prices, which have now declined for a 7th straight week. And we have seen these prices trade at around 9-month lows into the markets there. Even as the US dollar index is trading weak, that hasn't really supported the markets. And then you're looking at the US production and inventories, which also are at multi-year highs, impacting the prices. It's just not about the US production, but the OPEC and allies also are looking to increase production from the month of April, and that new supply would come into the market. The conversations between US and Russia also seem to be quite choppy. Whether or not these sanctions would be eased and will more Russian oil come into the market is another uncertain market that the street is looking at. And then it also is about the Chinese numbers, which have come in on the weaker side. The consumer confidence numbers came in weak for the first time in 13 months. That's also weighing onto the crude oil prices. So while we did see $70 come back, it's not been able to hold that. And even as we have seen nearly 7% of a decline in the last 2 months coming in for the crude oil prices, the street believes that you could be looking at further declines. There was an interesting report from IG which says that the crude prices can go down to 65, even 62 before we see any rebound from those levels.
Okay, all right, got it. Yeah, I mean, it's all happening. And I think Saudi Arabia is the theater of the latest action as far as that brokering that peace deal with between Ukraine and Russia is concerned. Got it, Manisha. So crude markets dealing with a lot of news flow. We'll take a break on that note, come back on the other side. We'll have Devang Mehta joining in to talk about some fundamental ideas. Welcome back to Trading Hour. We're looking at markets which are largely okay, though, of course, it's not a big one-way move that's building, at least not so far into the morning. So how do you position yourself, or how do you approach a market like this that's trying to find some stability after what's been a long correction? Devang Mehta is joining in. He's from Spark Private Wealth. Devang, 5 months. Indian investors are not used to seeing corrections that last for 5 months, right? Time and price. It's not been easy. First of all, is this, what are you advising? What are you doing? Is this the time to nibble in? And if yes, where?
Surabhi, thanks for having me on the show. I think, yes, it's been the last 5 months has sort of been difficult in the journeys of first-time investors, if I can say that. But people who have seen the cycle, maybe a couple of cycles, 3 cycles, or even more, know that this type of corrections happen in the bull market. This was a sharp correction. Rather than sharp, it was also a correction which was very meaningful. Which corrected the indices by 15, 20, 25%, respectively, large, mid, and small. But the stocks have corrected 40, 50, 60%. Honestly, if I can just attribute some things to the market, I know a lot of reams of paper have gone into why these markets have corrected, and I'll not go into that. But having said that, there are so many positives which the markets have ignored. Right from a positive budget to a decent type of earnings season, not so bad in terms of RBI infusing liquidity time and again, Delhi elections being won by the ruling party in the center. I think most of this have been events where this were a 300, 500 point cheer on the Nifty. But yes, because of the sentiment, what sentiment can do to markets and what also flows or absence of flows can do. I think that 2.5, 3 lakh crore being sold in the last 4-5 months has also had their toll on the market. Now, coming back to what should one do, and I think most important is an action point, whether the client should sort of revisit the portfolio, people who have not invested, what should they do? I think point number 1 is that very clearly, if you look at the portfolios, I think it's time to revisit or sharpen the portfolio. If probably you've missed out on great companies or good companies, and you have some gruesome companies in the portfolio. I know it will sound philosophical, but there are a lot of companies. I think everything and anything did well over the last 3-4 years. And now it will be time to probably sharpen the saw and do some smart sort of stock picking because everything would not do well. So now you have to follow earnings, you have to follow cash flows, you have to follow management commentaries. Probably would sectors change? I have my doubts. There will be certain sectors which will still come back to the fore after a huge bit of a price correction and valuation correction that has gone through. I think time for a lot of existing investors that just revisit your portfolios, look at whether the earnings have flowed. We are doing the same thing. I think our portfolio companies have grown very well. There would be a double whammy if the markets also fall and our companies don't deliver the numbers. It's a different point that the markets correct and your stocks correct along with that. But otherwise, I think most of the earnings that we have seen for our portfolio set of companies have been good. Yes, so the short answer is yes, one needs to nibble into this. These are opportunities which can create compounded annual returns rather than only returns.
Devang, I'm putting you in a tough spot here, but I remember in last year you had said Trent was one of your top holdings. Is that correct? At some point of time, was Trent one of your top holdings in your portfolio?
So I think our portfolio was more to do with, absolutely right, our portfolio was more to do with capex-oriented businesses, a lot of capital good ancillaries, power automation stocks like Hitachi Energy, you would recall, and Trent was also a meaningful part of the portfolio, and it still remains.
And what have you done with Trent, given the kind of correction that we've seen in the stock price?
Entire market right now is collapsing in terms of where there were high PE ratios. The so-called expensive valuations are now cracking. But most importantly, if you are confident on the numbers that the company will deliver, yes, there may be a couple of quarters which can probably have a miss in the life of this company. But if somebody has a horizon of 3 to 5 years, I clearly feel that the organized retail, there are very less candidates, right? So you probably have a scarcity premium in a few of these businesses. There'll be a couple of other businesses which are listed, but not as the class which Trent would probably command in terms of earnings and cash flows and valuations. So my sense, yes, valuations can there be a 5% correction more on this type of businesses? It can be. But would you be able to price to perfection? Answer is no. I think these are companies which one should probably, if they are not owning, they should start to own as well.
And in the course of the last couple of months, as the stock was correcting, did you add to your position?
Yes.
Or did you reduce you've been adding to Trend? Okay, got that. Any other changes that you made in your portfolio? I know we've spoken about power, the stocks like Hitachi, etc. But what are the key changes that you've made in your portfolio? Because this correction has provided an opportunity.
I think, yes, most importantly, we are looking at certain businesses in the discretionary consumption space as well. So I think I've spoken about that in the past as well. Some hotel businesses, organized retail, as I said. A lot of such businesses which you had sort of always missed out because there was no correction over there. Also, certain businesses in the financial services. Now, again, I'm not talking about the traditional banks or the traditional NBFCs, but most importantly, the broking houses, the wealth management houses, the AMCs, depositories, exchanges. We have seen a great correction over here also. I think this is one segment which we are nibbling into and which are looking at very, very positively.
Okay, so that is one space you're looking at. Devang, EMS, I'm just talking about themes that could just not go wrong before we got into this correction, right? People were looking to buy into EMS stocks at any price, and valuation multiples went to 90 times, 100 times. Where do you stand on this now after the correction?
I think we are not probably nibbled into any of this EMS stocks. There are a lot of proxy plays via which we played it. So honestly, there are what would be required if the EMS companies thrives. There would be semiconductors which will be required. There will be air compressors which will be required. I think power automation. I think a lot of such businesses would be required once India goes into the curve. Companies like which are into the HVDC, high voltage direct current anvil. And I used to talk about Hitachi Energy, which again has come with a 500% EPS jump. So most of these companies have delivered good numbers. I talk about air compressors, the companies like Ingersoll Rand, which again came up with good set of numbers. But again, yes, markets have sort of punished the businesses which have come up with even good set of numbers. So I think rather than playing the EMS, I would also play the last mile proxy in terms of if there is networks to be established, if there are warehouses to be done, if there is EMS to be happening in India, if there are a lot of big plans that are going to come to India, I think what would be required. And here I can be very vocal in saying that there are no large cap businesses available in this universe, because if you want to sort of buy large caps, I think 60 to 70% of the universe would be IT, financial services, as well as your FMCG. And oil and gas. These are companies which will be available out of the index, maybe out of Nifty 50 or out of Nifty 100. So I think a lot of mid and small size businesses which have corrected here should probably be looked into. As I said, probably if somebody don't has the confidence, you can probably do it in the couple of tranches or 3 tranches in the next 2-3 months.
Thank you very much for that. We will slip into a break. On the other side, we'll discuss market technicals with Soni Patnaik from JM Financial Services.
Hey, thank you for watching this on CNBC-TV18. Hope you liked it. For more such interesting news and updates, follow CNBC-TV18 on all the social media platforms.
Welcome back. Let's get some trading ideas going as well and look at the technical picture of the market. We have Soni Patnaik joining in from JM Financial Services. Soni, so there's been at least some green on the screen of late, right? What are your calls? I don't know if you're trading the index, otherwise individual stocks. What are your recommendations?
Hi, good morning, Surbhi, and Rima. Thank you so much for having me on your show. So I think Nifty, we can see that 22,600 put options is adding some open interest today. It is mostly on the buying side today, and 22,800 call option is also adding. So I think that range of 22,700, 750 could be the place or the range where Nifty fizzles out this up move and some profit booking can be seen. The support right now has risen from 22,300 to 22,400, 450 odd levels. So that could be the level again where Nifty retests those support levels. And again, the move from the up move can come from those levels. I think it's wise to stick to a sort of a stock specific strategy. And, you can see both buying and selling in options coming in from the stock specific ideas. Likewise, we are recommending a buy and a sell option for today. The buy recommendation comes in for Bharti Airtel, which has seen a good move above all its shorter moving average today. So one can buy Bharti Airtel at current levels of 1645, keeping a stop loss of 1625 and a positional target of 1680 to 1700 can be seen. The sell recommendation comes in Trend. Trend has seen a fresh breakdown today, again below 5,000 odd levels, again below all the short-term moving averages. So one can sell Trend in March futures, keeping a stop loss of 5,000 and a target of 4650, 4700 can be seen for current levels.
Thank you very much for that, Soni. A nice haircut, looking good. And thank you for joining in. We will slip into a break, and here is a quick note for all our viewers. Numbers tell a story, but actions drive change. To close, the gender gap index reveals where we stand, and future female forward charter charts the way forward. So don't miss out on this landmark moment in the conversation on advancing gender parity and closing the gender gap. Watch it live on CNBC TV 18 today, 5:30 p.m. onwards.
Welcome back. Here with us on Trading Hour. We're putting the spotlight on new age internet companies now. A lot of these companies obviously are still new to the market. Many are between 1 to say 3 years old, some of the older names. But a lot of them have gone through correction along with the rest of the market. Many are off 20-30% of their peaks. Now we're putting the spotlight on this conversation because some of the mutual fund houses did launch digital funds late last year. Motilal Oswal itself has one such Digital India fund as well. And we have the fund manager joining in. It's a very new fund, very young fund, launched only in November of 24. Varun Sharma looks at, of course, this fund. So Varun, it's great to have you on the show. Welcome to the program. And we wanted to bring you in to really understand, because the market confidence obviously has been shaken up. And people are wondering that if these high flyer digital companies, internet companies, whether they can go back to their past glory. Let's get your opening thoughts.
Thank you for having me here. Yes, I think absolutely. We've seen multiple market cycles in the past also. But what is important is that we keep our eyes set on the business momentum. And we are seeing fantastic business momentum out there, especially on the consumer side. The consumer adoption is only growing. And most of these companies, when we're looking at the entire ecosystem itself, growth rates are very healthy. So nothing has changed from the business standpoint, and nothing has changed, irrespective of the market cycles. The business cycles are very strong.
Varun, just looking at some of your top holdings, and they'll come up for our viewers. You've got Zensar, Zomato, PB Fintech, Info Edge, Affle, Tech Mahindra, Birlasoft, RateGain, MapMyIndia, Infosys. A lot of your traditional IT services companies also find their way into the digital fund. A lot of people ask us, right, which of the IT companies are at the forefront of this entire AI wave where, the DeepSeeks and the Alibabas and the NVIDIAs of the world are doing so well. In India, in the tech space, because you track a lot of these IT companies and they make their way to your fund, which companies would you say can really ride the digital boom and the wave that we're seeing?
See, the Indian technology ecosystem is a bit different from when we look at globally countries, especially US and even, China. So we have IT services companies which have become, or the entire ecosystem which has become big here. But we are also seeing that digital companies or core technology companies emanating from several other areas. Now, within IT services also, there are companies which are growing fast, which have differentiated strategies. There are also opportunities when it comes to turnaround stories where companies may not have done well in the past, but because of the change in management or strategy, these companies can do better in future. So they do find a place in these digital and technology funds. All across, we cannot compare it on a like-to-like basis, but yes, there are certain companies which are catching on and latching to these global trends, and they can benefit out of those. As long as those companies can demonstrate high growth for a longer time frame, they will definitely find their way in our digital fund.
So, Varun, the question is, let's go segment by segment, because I know you can't get into individual stocks, but let's try and understand the growth potential and then the valuation reality around it. So starting with food delivery and quick commerce. I mean, no one's denying the fact that there have been massive disruptors. We're all completely hooked onto our apps. But the question is, can the moat be a sustainable one? Or is it a bit of a race to the bottom with discounts, etc.? And more importantly, many of these companies, especially on the quick commerce side, they've also said that they're going to be investing more in dark stores and expansion, etc. So from a market perspective, what about valuations? What about profitability? And what about ultimately, return expectations over the medium term?
See, what we've observed globally is that when it comes to internet stocks and retail stocks, and specifically those companies, typically the biggest moat is the scale itself. because the entry barriers usually are not very high. So most of the companies globally have also focused initially only on garnering a very high scale. And it is not uncommon to find, these sub-segments to be winner-take-all markets. And we've observed these characteristics even in India, in several other areas of digital, where digital has become mainstream. So typically, this is the behavior that these companies always go after growth and very high scale first. And then usually the profitability comes in because the market also matures to some extent by that time. And the consumer behavior also changes towards the adoption and towards the convenience that these companies bring to them as compared to what is available in the offline ecosystem. At the end of the day, most of these companies are empowering their customers. They are basically shifting the power away from suppliers to consumers, and this is the primary reason why this leads to such high consumer adoption and such accelerated consumer adoption. Now, keeping that in mind, when we look at these companies or try to value these companies with traditional valuation methods, they have typically not worked even globally in the past. And that is one mistake that we at Motilal Oswal do not want to make. Having seen the evidence outside, the traditional valuation methods do not work. And that is something that we've discussed and written on extensively, that these companies need to be looked at in a different fashion, through a different lens, and need to be valued differently than what we usually do in case of other traditional companies.
That's a point well taken, absolutely. And I think we've all realized that when they came to the market talking about price to sales, then the earnings had to come in and all of that. We've gone through that whole cycle. My question is more on whatever lens you're putting on now to look at valuations. What would be the right, whether it's a PEG multiple or whatever multiple you're looking at, what is it that you are comfortable with? What is the multiple expansion trajectory? And aren't the multiples of these companies here in India still way higher than, say, some of their counterparts in China? So isn't that a risk with respect to attracting more foreign capital whenever those FPIs return to our market?
See, we have to also do a like-to-like comparison in terms of the life cycle of these companies, where our Indian companies are versus where the China or the US companies are. We are fairly nascent, we are fairly small as compared to the companies elsewhere, where companies have become big. And when we do these comparisons on a life cycle basis, that we are in that nascent stage and how those companies and how those businesses used to operate when they were nascent, then we are actually, at similar stages. If we go back 10 years, 15 years, and then compare in our digital companies with the US or Chinese companies. So from that perspective, there is no difference. Coming to valuation, see, when we look at valuations and we just broadly dissect them into business compounding and, or let's say when we're looking at stock price return and dissect them into business compounding and valuations, what we usually observe is that business compounding is happening at a very, very healthy rate. And valuations, even if they don't improve, then we should expect that, in the longer term, stock returns are a function of business compounding rather than valuations. If valuations improve, good. But if they don't, then business compounding is something that is very important from a longer term, stock returns perspective. And that is where we are seeing that from a business standpoint, the business is only becoming bigger, the business is becoming stronger. And once they reach a threshold, once they reach critical mass, then profitability and cash flows are also a given.
So just to wrap this up and give some advice to our viewers, fresh money allocation, would it be to your e-commerce, quick commerce type companies? Would it be to IT services companies? Would it be to fintech companies like PB Fintech? Where would incremental money be allocated to at these levels?
See, when we look at IT services as an industry overall, we don't find it too lucrative because of low growth prospects from a longer term perspective. We find digital ecosystem to be extremely, extremely attractive and lucrative from multiple decades perspective, because this is a very high growth ecosystem. And as I said, from a longer term standpoint, it's the business compounding and business scale up, which will help generate returns and create value. Rather than finding value in low growth stocks, and that is something that we would never advise. We would always advise towards capturing business compounding and making use of these stock price movements in the short term to strengthen portfolios and actually improve the overall portfolio positioning in the digital ecosystem.
Okay, all right, Varun, this has been an interesting conversation. Thank you very much, and we hope to have more of them as the months progress. Let's see. You definitely are quite optimistic on the prospects ahead. We will take a very quick break on that note. On the other side, we'll come back with lots more. But as we take that break, here's some good news for our viewers. India's business news leader is now just a click away, introducing CNBC TV18's all-new app. You can get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. You just need to download the CNBC TV18 app now from the Apple Store or from Google Play. You can, of course, also scan the QR code that's on your screen.
Welcome back. The Midcap index is still flat, but stocks are lively. So Castrol is rapidly cutting its losses now. It's still down close to about 1.25%, but it's recovered 4.5% from the day's low. And remember, it was the big winner last week. So Castrol has moved up in the last 15 minutes. Bharat Dynamics in the green, up nearly 1%. Narayana Health is popping up on the volume charts. So that's another big mover. 12% up on Narayana Health so far in the month of March. But let's get to Bharti Hexacom. The stock is flat today, but keep your eye out on it because Motilal Oswal has initiated coverage with a buy rating. The target price stands at 16.25, so nearly a 300 rupee upside from current levels. And here are two key points. One, they're saying that we prefer Bharti Hexacom over Bharti Airtel, despite Hexacom being at a premium. And the only reason is because when it comes to Bharti Airtel, there are concerns about misallocation of capital. Mr. Mittal has spoken about making some acquisitions. So therefore, they believe there is a risk that the capital that Bharti Airtel is generating, the free cash flow, may be misallocated, and therefore their preference lies with Bharti Hexacom. So that's a stock you should watch for.
Absolutely. So that's one more name on our list, on our radar. But let's get you some perspective now. I was at the Money Control Global Wealth Summit on Friday, where I got a chance to interact with a bunch of foreign investors that are looking at the Indian market very, very carefully. This included names like the managers at Warburg Pincus and also global wealth titan Amundi, which manages over 2 trillion euros in assets. Listen in to what the conversations were like. I did ask them about a range of issues, including whether capital gains tax is a real niggling worry for foreign investors in India, and how do Indian equities stack up considering the currency depreciation angle as well as a call on valuations here right now.
Investments and global flow of capital around the world has historically been more and more frictionless because you haven't had this concept of let's tax in each country any global capital that comes in. Over time, that has changed. I think the view we have taken, and I've heard many private investors take, is you want consistency of tax policy. Now remember, India is competing for global capital. As I sit outside India and as all of us on this panel sit outside, we have multiple places in the world to invest. And many of them have no tax on global capital when you come in. So when you do come into, it's not whether it's right or wrong. You want it to be consistent. And whatever we do, realize it does disadvantage us, right? Versus other places that don't have that. Having said that, India has to chart its own course.
On the valuation side, yes, India is more expensive than most emerging countries' equities, but this is a price you have to pay for growth. When you look into forward ROE, so return on equity, you have more than 15% in India. This is not something you can see in other big and large economies. So we would say that yes, valuation was a concern, take profit, a cyclical downturn temporarily. We expect this year 6.5% of GDP growth in India. We do expect this is a new potential growth over the next 5 years, so it's a medium term. So there is a fantastic bright spots within the emerging economies. So we are coming back to India those days more tactically to reweight our overweight positioning in our portfolios. when you're a global investor, or when you're investing for a global sovereign fund, let's say you open a mandate and you will have a global asset allocation fund, it's very unusual for you to open a bank account in India bonds, despite the fact that you would like to try it out. Why? Because it will be relatively minimum in your global exposure, and two, because it's time consuming, you have some tax. So we noticed that there is a lot of, I would say, inefficiency that are created. Investor or foreign investor are piling into SSA. So supranational, denominated and settled in dollar, that are actually mimicking what the India bond is doing, with one, not a perfect correlation, but the strong appeal is that there is no withholding tax. So I think this is something happening, and you see that those instruments are less liquid than Indian bonds, but at the end of the day, you can win 1 to 1.5% more in terms of coupon and carry on a yearly basis because you don't have tax. So this is something happening, and I think it's preventing foreign flows to come massively to Indian bonds markets.
Interesting conversation, and we'll keep getting you snippets from there, but let's get into a break. But as we do that, from breaking barriers to rewriting the rules, our exclusive Future Female Forward Mega Summit brings together voices that matter. Don't miss this power-packed conversation on enabling success, driving parity, and shaping a more inclusive future. Tune in to CNBC TV 18 today, 5:30 p.m. onwards. Welcome back. The Nifty is now closer to 22,600. The Midcap index has also dipped into the red. As we wrap up on trading hour, let's get you the latest on tariff threats. Donald Trump has shaken up the world economy. And here's the latest. In an exclusive chat with CNBC, Treasury Secretary Scott Bessent talks about the effect of tariffs and comments on the push for a stronger dollar. Listen in.
The Biden administration created this bad equilibrium where the top 10%, people in this room, probably most of the people watching this show, top 10% of Americans are 40 or 50% of consumption. And that is an unstable equilibrium. The bottom 50% of working Americans have gotten killed. We are trying to address that. We're trying to get rates down. And could we be seeing that this economy that we inherited starting to roll a bit? Sure. And look, there's going to be a natural adjustment as we move away from public spending to private spending. The market and the economy have just become hooked. We've become addicted to this government spending, and there's going to be a detox period. We are committed, this administration, President Trump, are committed to the policies that will lead to a strong dollar. If we bring back more manufacturing, if we have cheap energy, good tax policy, deregulate, we will end up with a strong dollar. But what is unacceptable is in a bilateral relationship, other countries trying to weaken their currency. And so we are against the currency manipulation on a bilateral basis, but globally, the strong dollar is very important. We will continue as a reserve asset.